Yeah, Nick always has good points. So, he's kind of my go-to guru when it comes to the early stage exploration stuff because, I'm always trying to get a good grip on not only the producers, but, the royalty streaming companies, the development stage, and the explorers. And, I really, the way I look at it is when you're a retail investor, you want to go with the lowest perceived risk plays. And for the most part, that's, sticking with a tried and true kind of proven producer because, even if a mine, like one mine has issues, if they're a mid-tier and, they have good assets, but they have a decent diversification, then, one mine is not going to make or break a company. And one good or bad drill hole is not going to, change the landscape for the company either. And, they generate free cash flow, they can raise capital and all that stuff. So for the retail investor, I'd say, that's probably the most prudent course to start with. But, like I was mentioning to you guys, after a while in the cycle, though, it gets to a point where these plays that are perceived to be less risky, they actually, in my mind, they become more risky because they get bid up. Like, for example, like First Majestic, again, it got bid up to $3 billion valuation. But when you look at the fundamentals, this is, and I'm not knocking on the stock or anything like that, but it's a primary silver producer, and they produce about 20 million silver equivalent ounces in a year. But then you had like gold companies, like for example, like B2 Gold, right? That's like a 500K ounce gold producer a year, and First Majestic had a higher valuation than B2 Gold, right? If you're retail and you're chasing price action, you're not going to know how to distinguish the two. You're not going to be able to look at the, the free cash flow or the revenues, and you're just going to chase kind of hype and momentum, and that's the thing where you have to be careful of, because it's just because you're going with a proven name, it doesn't make it less risky. Because depending on where you are in the cycle, these stocks do get bid up, right? So for myself, when I see these producers, and I'm like, it's gotten bid up so much. If the spot price of gold and silver starts to decline, or there's a drastic pullback, these stocks are going to get massacred on the way down because they've gotten bid up so much, right? So the thing is, you're trying to be proactive. You're trying to react and make these moves and decisions before that event happens. So it got to a point where like even last month when I was talking to you guys, and I was like, I'm not finding any good ideas in the mid-tier space anymore. So then you start looking at stuff like the development stage stories and the early stage explorers. So that's the also a challenge in itself to kind of decide which path you want to pursue. Because, for example, if gold was let's say $13.50 an ounce, right, then you're looking at some of these development stage stories that are still kind of affordable because they're optionality plays. But if the optionality play is very close, like let's say gold's $13.50, but the optionality play doesn't work until gold's $14.50, in your mind it might be worth kind of that risk in a sense where, it's just around the corner. Like if gold just has one leg up more, then this optionality play will actually be in the money, and it'll probably get re-rated significantly at that point. But you kind of have to do your, research and due diligence and kind of figure out, like, do I want to pay, for example, 60 million market cap for an optionality play? But, it has proven ounces. Let's say it's like a 4 million ounce, resource. So there's less risk involved in that sense because they've already drilled out the whole project. Maybe they have a feasibility study completed, right? Versus an explorer, let's say that has a $35 million market cap or a $40 million market cap. You draw the line in the sand somewhere where, for me, it makes no sense to chase an early stage exploration play that's, let's say it's a 55 million market cap, when I can get an optionality play that's just on the cusp of being in the money, and it's only $5 million more in terms of market cap. Well, it really depends on your risk reward appetite, because maybe the early stage exploration company at 55 million might be onto the next Voisey's Bay or something. Then you could justify the risk Rubicon involved. Or it could be the next Rubicon, right? So it depends on your risk versus reward appetite. So if I'm talking to kind of a retail investor who's just getting started out, of course I would have to gravitate more towards the optionality play in that scenario, because it's almost trading at the same valuation market cap. But you're going with a proven resource in that sense, where it's already been drilled out. Let's say it's 4 million ounces, and everything is basically shovel ready. It's just the spot price doesn't work. That's the only thing that's holding this company back. And I was talking to Nick the other day, and there's a great example of this, a company we were talking about. And should I just mention the name of the company?
Yeah, sure.
Sandspring Resources is a very good example of that one. They're finishing up their feasibility study, but they have a pre-feasibility done. They have Silver Wheaton as a partner, so that's a a lot of vetting, if you will, and due diligence, because I think it's like $150 million streaming deal, to finance the mine construction. So Sandspring is one of those projects. It has I think 4 million reserves and I think 10 million resource, and it just doesn't work at today's gold price, but it's trading at a attractive enough valuation where it starts to encroach on the valuations that you would kind of affix to the early stage exploration stuff. So then as an investor, and again, this is all dynamic, right? Because right now with gold back at 1250 range, then Sandspring doesn't look as appealing because it's so much further away from being in the money. So at this stage of the game, you might say, well, I'd rather go with the early stage exploration stuff because it might have more short-term catalysts for growth and price action and movement. Something like Sandspring might stagnate more when gold's 1250, but if gold's 1350, it might be maybe a very good buy because you're getting optionality that's just around the corner, and it could really get re-rated massively. Once it's gold hits 1400. So those are just things to keep in mind. It's not always so black and white, and it really takes kind of a lot of analysis and just kind of playing around with different ideas, looking at all these different scenarios, and I guess ultimately you just have to go with your gut.
Yeah, you have to pull the trigger at some point, and it's not going to be perfect because all of these companies are very risky, even the big ones.
There's no guarantees in mining.
Yeah, I'll just add, it's cool to mention that because so for the record, I don't own any shares in Sandspring, but the last time I chatted with Jay, I brought it up as just one on my radar, and it fits with what I described earlier, where it's an optionality play, but you don't need gold to go much higher. But to Jay's other points, it's a perfect example of what is your own, risk reward spectrum, where do you consider to have your own expertise? I personally feel I may buy Sandspring in the future, and maybe I'll regret it. I'll miss it out. Jay just told you about this great play, and I'm the one who mentioned it to him, and somebody else took advantage of it. That happens all the time. But going back to Orca Gold, that's one where it's more of a combination of a development play and an exploration play, and it's worth 40 million. So 40 million versus 60 million, but you've got all of this stuff already developed, and both of them are in somewhat risky jurisdictions. But Guyana's clearly better than Sudan, and we'll see what else happens. But for me, I'm trying to piece in all these other factors that are much harder to understand, and absolutely for a newbie type person, I would be stick with something like Sandspring, where you really the core thing is to think about if you're betting on the price of gold going up a little bit, this is a pretty good play to have versus needing to put all these other pieces together. But that's where it comes down to a case by case basis. What's your individual interest? I also want to just add a couple other things. I know that Fabi is much more following newsletters and from our previous conversations. And I like to buy stuff before the newsletters, but there's nothing wrong with buying newsletter subscriptions and taking advantage of that. I don't feel like that fits me as well, but there's people who make money with that all the time, even making money with the types of plays that have been hyped up and are going to get further hyped up. And it's just, that's a different style. And as another example that Jay touched on a little bit, there's a lot, you can make a lot of money with royalty plays. I mean, there's big royalty plays, but there's also smaller ones. And I don't understand them as well. And I guess I could look into them more, but that's where you can play around with the math. And sometimes you'll know, this thing has to be undervalued. But oftentimes those royalty plays aren't hyped up as much, so it's a little more of a waiting game. But yeah, I'm just throwing out. There's so many ways to make money in this. So even though I've got my own way, Jay's got his own way, and Fabi has her own way of doing it. It just make it clear. There's just it's neat to explore, and you won't know what fits you best until you start experimenting for yourself.